gonna let the panelists introduce themselves, and we're gonna start from the right. Well, a quick intro on myself. My name is Tom Bass, and you guys have seen me enough. I'm the head of research at Brave New Coin, formerly Bear Stearns, JP Morgan. Completely quit Wall Street. Now I'm just in Bitcoin space. And Brave New Coin, we like to think of ourselves as the Bloomberg of the crypto industry, with data collection, building an index, and then use division. And I will let the panelists introduce themselves. And we're going to go ahead and start with Reggie in the middle.
My name is Reggie Middleton. I'm founder of Veritasium, which is a small contracts startup that basically attempts to take the business functions of Wall Street banks and congeal it into blockchain peer-to-peer transactions. Previously, before then, I was a self-directed investor, did my own analysis, and I'm known in the media for calling the fall of Bear Stearns, his former employer, Lehman Brothers, Countrywide, Washington Mutual, sovereign debt crisis, technology, BlackBerry, etc. Roughly about 82 successful calls, and because of that, a lot of people see me in the media. I've been in CNBC, Business Challenge, every day they've had it for 2 years, etc., etc.
So go ahead and mention what your Veritasium does. Might as well.
Veritasium uses smart contracts to enable, it's a smart contract enabled wallet that allows individuals and entities to trade directly value with each other. You use about 45,000 tickers, any asset class, any geographic board. So you could go long IBM, short gold, long Facebook, short the US dollar, long the Ukrainian hub, euro pair, short electricity futures index. And you do it on a zero trust basis. You don't have to know the other side or trust the other side, and there's no counterparty risk. It's as safe as the blockchain. If you have full belief in the blockchain, there's guaranteed deliverable and settlement. Settles in real time. Bitcoin in, Bitcoin out.
Awesome, thanks. Scott, you're up next. To tell briefly about yourself, and what Alphapoint does.
So briefly about myself, I'm a sales leader. I've worked for 3 different software companies in Silicon Valley. I started a couple companies myself. In the start of 2014, I joined Alphapoint and have been growing that business for the last 2 years.
And Alphapoint is?
Alphapoint powers exchanges, so we're a white label exchange provider. It's a platform that will enable you to launch an exchange in about 20 days.
Awesome. And unfortunately, Ed couldn't make it, so we're skipping right ahead to Craig.
Hey guys, I'm Craig Sellers, co-founder and CTO of Tether. We put fiat currencies directly on the Bitcoin blockchain. We use technology called the Omni Layer, which is basically a technology and a protocol that puts private blockchain technology on top of the Bitcoin public blockchain. I'm also a technologist for Bitfinex, which is the world's largest Bitcoin USD exchange.
Awesome, right, so we're going to go ahead and jump right in. This is a panel mostly talking about exchanges, and you can't talk about exchanges without talking the history of exchanges. So we're going to kick right in with the very first Bitcoin exchange of Mt. Gox. We kind of all know what happened, but what are your views on the opinion of Mt. Gox and what it stood for? For example, I'm very happy that Mt. Gox came into existence, partially perhaps because I didn't lose any money in Mt. Gox. I wasn't trading on it, but they took the initiative and they joined the space and they created the very first exchange and established an initial price of Bitcoin. And what has happened since then? So I don't know if anybody wants to comment on the history of exchanges and how it's evolved.
I'll kick it off. Is the book called Digital Gold?
Yes.
Yeah, so I read Digital
Gold.
Yeah, so I read that book. You guys haven't read it, it's fantastic. And it really details the early days of Mt. Gox. Yeah, Mt. Gox played a great role initially. It's funny how small that company was, and yet it had this huge global impact. And the book gives great insight into how he was managing this basically global exchange with a laptop at times. So yeah, I mean, it certainly played a crucial role. As we know, exchanges are price discovery mechanisms and sources of liquidity, and that's exactly what it did for Bitcoin in the early days.
Mt. Gox, for me at least, was one of the impetus for the creation of Tether. As Mt. Gox began to fail, one of the things that started that process was the U.S. government seized their U.S. bank accounts. And so US customers had no way of getting dollars out of the system. So all they could do is if they had balances on Mt. Gox, they could buy up the Bitcoins that were there, and of course with limited supply, that drove the price up. They could withdraw their Bitcoins, but they couldn't withdraw their dollars. And the question was, why can't I withdraw my dollars into my Bitcoin wallet? That makes no sense to me. So we decided to create the ability to withdraw dollars into your Bitcoin wallet. At the same time, though, we can talk about the generations of technology and companies within the Bitcoin space and the lessons that have been learned from the previous experiences. Bitfinex, as an example, like I said, is a very large US dollar Bitcoin exchange. And so many of the security concerns that are there have all been from looking at failures in the past. Mt. Gox, of course, being the largest.
I'd like to comment because oftentimes when there's a mention of Mt. Gox, it's a connection with some type of failure in Bitcoin. Mt. Gox was pure management execution error. And that's what it was. It wasn't a failure in Bitcoin protocol. As a matter of fact, they didn't really use Bitcoin. With Mt. Gox, you took your Bitcoin, your assets, you relinquished control, possession, and custody of the Bitcoin. You sent it to Mt. Gox somewhere in Japan, allegedly, and they simply relinquished it. They disappeared. Mt. Gox had a management execution error. They collapsed. You lost your assets. The power of Bitcoin is you don't necessarily have to do that. You can not more than bifurcate. Trifurcate, that's a word. Possession, control, and ownership of the Bitcoin. Because Mt. Gox's business model did not rely upon the powers inherent in Bitcoin, that fall was spectacular and happened the way it did. And it happens. Management executions happen all the time, not just in Bitcoin, US dollars, euro, etc., BlackRock, Lehman. I just want to make sure that we all understand that Mt. Gox was the failure of management, not the failure of the underlying technology or the asset that was used.
Yeah, and I always say that it's a great example of free market because Mt. Gox failed. Now, we're going to get to regulation in a minute, but they say, well, Bitcoin needs regulation. And I'm like, well, guess what? If Bitcoin was fully regulated, imagine if Mt. Gox would have gotten a bailout because it was too big to fail. So you can also think about it that
way. To Reggie's point, actually, you talk about relinquishing control over your assets. It was not a technological failure of Bitcoin, it was a managerial failure, but it spawned the creation of decentralized exchanges, such as Veritasium, OmniLayer as well. So even though there were managerial failures and the technology was fine, it inspired greater technology to prevent those managerial failures in the future.
Yeah, and from a sales perspective, I talk to people all over the globe every day. In the start of 2014, I couldn't get through a phone call without somebody bringing up Mt. Gox. And I was just like, yeah, I understand. Yeah, there was issues there. But what quickly happened, from my perspective, was, the industry as a whole got past it. The industry survived, became a lot stronger from it, from what these gentlemen are pointing out, from a technical perspective. And I think overall, Bitcoin became much stronger from it.
No, I agree with that. All right, let's jump on to the next topic, and it's a matter of trust. So what I like to do is I like to separate trust and regulation into forms. So I always try to separate the questions. So this is normally a question I raised to get kicked off with the CTO on the panel. I don't think we have a CTO this time, but I guess I'll let Reggie kick us off. How do you create an exchange to generate trust without the human element of trust, without a law, without a mandate? Is it possible to design something that is inherently trustworthy, kind of like Bitcoin is itself?
Thank you for the question. What we do is we essentially take the blockchain and replace the transactions counterparty with the blockchain. Actor A wants to go long Bitcoin, short US dollar. Actor B wants to go short US dollar, long Bitcoin. Normally they face each other. Either a fiat transaction or I'd say a legacy institution, Citibank, some of the centralized Bitcoin exchanges, etc. With a peer-to-peer transaction, they can deal directly with each other without having to trust an intermediary or middleman. That intermediary middleman would be a well-funded Bitcoin company, Citibank, JP Morgan, etc., or Mt. Gox. And on top of that, when they do escrow their funds, now the blockchain becomes a counterparty. And if you believe in the integrity of the blockchain, that's the integrity of the counterparty. We call that a counterparty risk-free transaction or a zero trust transaction. You've taken out a significant amount of risk, eliminate credit risk, you eliminate counterparty risk, and you eliminate execution risk. As far as blockchain is accountable and reliable. And I think most people who follow this series believes that the blockchain is inherently immutable, I assume.
Anybody else want to comment?
Well, I can see that another component of that, when you don't have a purely decentralized solution, which by the way I find elegant and beautiful.
Thank you.
But when you have a centralized solution, there are other aspects of trust that you'd like to get across. One of the failures of Mt. Gox, of course, was there was no transparency into where the assets were, who held the assets, etc. One of the things we've done at Bitfinex is actually partnered with a company called BitGo, which manages multi-signature wallets. It's such that every deposit or withdrawal that's occurring on the Bitfinex platform, and then subsequently every single trade that occurs, is actually settled on the blockchain multi-signature accounts. And so at any point in time, you can actually look at the Bitcoin blockchain and see exactly the position you hold within the exchange. So therefore, it's cryptographically protected and secure and demonstrable across the entire blockchain.
Let's let Scott kick off the next topic, which is a topic of regulations. And what I say, actually, I kind of hit me when I was on a panel at MIT. Thank you, Mitchell, for that one. And someone asked the question, well, what kind of regulation would you like to see within the Bitcoin space? And my answer is, my default position has always been no regulations, because I'm not a fan of them. But as I think about it, I would actually like to see very hard regulations on the business for consumer protection side, which means at the time, the person next to me happened to be the CEO of LedgerX, which hasn't launched yet, but they're going to launch options on Bitcoin. And that is a very leveraged, very dangerous instrument. And what I said was, for a company like that, I would like maximum regulation to make sure that he's actually holding his customer funds, or if he can show it some kind of way. I want that regulated to make sure he's not running away with people's money, and to make sure he's not leveraged to the gills to form the next long-term capital management within the Bitcoin space. However, I want zero regulation on people and their property. So I want all KYC, all AML to be abolished personally across the world. That is a dream I know I may not ever see, but that's my utopia for regulation. So I wanted to get the panel's take on the human element of regulation when it comes to exchanges and value transfer within the Bitcoin space, what you think is going to happen and what you would like to happen.
So I'll kick it off. I probably share your views quite a bit as well. If you're going to be taking in somebody's money, especially if it is an exchange that includes a national currency, so we're not talking, well, maybe even with a digital exchange as well, but let's say a US dollar to digital exchange. If you are receiving somebody's dollars, or if you're a centralized exchange and you are receiving their Bitcoin, any kind of value, consumers do need to be protected. And we don't want to have people getting scammed. That's just not cool. At the same time, we don't want to have so much regulation that it's over-regulating companies that don't have any control over the value that's stored. So within the context of exchanges where they're centralized and you do have to send your collateral in, either dollars or digital value, I think it's important that there is regulation. I think these guys should be monitored, and they should be able to prove that they're legitimate.
What I'm seeing along those same lines is, I remember reading the Ripple settlement agreement, where they had to agree to, actually they didn't have to agree to, they were forced to make changes to the protocol for traceability and reversibility in certain cases. And of course, being a private ledger that they themselves controlled, they could fulfill that demand. In the Bitcoin space, or in the public blockchain space, the protocol itself is not defined by the organizations that use it. And so those kinds of rules can't be enforced. And so what happens is the regulation actually gets pushed to the borders or the threshold of when people are getting into or out of that decentralized system. And I think one of the things we should actually be doing as an industry is informing the regulators more on what that boundary actually is and how it can be used for consumer protection.
I'd like to chime in. My business recently came under the purview of the CFTC, and going through CFTC regulation, it became painfully obvious that the day that announcement was made was about 3 weeks, maybe 2 years after it was obsolete. So basically it was obsolete in real time. When you regulate something, at the very least read the directions. Bitcoin is programmable. It is very malleable. It has its own transportation rail. So if you're going to regulate it as a commodity, it is not pork bellies. You know, it is not corn. It can easily take the form of another asset and see a commodity. It can emulate cash flows. It can basically be something else. So when you pass regulation, you should work with those in the community to form the regulation. The right regulation that is obsolete as soon as it's passed does no good. It doesn't protect the consumer because you have financial engineers who are going to engineer their way around it. It doesn't foster innovation because it costs startups more money to try to comply with, and it doesn't protect consumers because you have bad actors again who will find ways around the regulation. So my best wish is to have smart cooperative regulators. I guess that could be synonymous if everybody had the same interest.
How long until regulators are replaced by smart contracts?
Well, technically, 6 months to a year.
No.
Legally, who knows?
Yeah, legally it's gonna be a while. You know, my view is the same with you, Reggie, and it applies to like all levels of finance. Even in, like I said, whatever regulation they come up with to prevent the next 2008 crisis is irrelevant. It's not gonna happen again.
Right.
Crises in financial markets always happen when everyone that remembers the last crisis is already like dying of old age. Because people have memories. Wall Street doesn't want to see another 2008. They take advantage of a situation until it crashes, and then they all remember, and they're not going to do it again until they all pretty much are starting to die off. So the next crisis I foresee is a crisis in government bonds, which was in 1931, and everyone is about 70 or 80 years old. Well, yes, you had a question, Kevin.
Just a brief comment. Keep your eyes on the budget bill that's going through Congress right now, because there's going to be some emergency terrorist financing provisions in it, and I wouldn't be surprised if they put something in there to do with Bitcoin, because it's been
I'm personally surprised that hasn't been in there yet, but until they have a magical way to control Bitcoin, I don't see, my personal view is that the fact that too many lawmade people that come up with economic laws are actually lawyers and not people that have traded and people that have dealt with economics is one of the reasons why the liquidity of the world and all assets is going down.
Carol, do you
And
know if
eventually that's going to change.
Do you know if the Chamber of Digital Commerce or anyone else is lobbying on the digital currency industry's behalf?
I'm not sure it's on anybody's radar screen, but there's been a series of hearings over the last several months where this issue has been brought up multiple times, and it's very much like when the Patriot Act went through back in 2001, where they threw anything that's been sitting around that they wanted to get through, went into this mess that became the Patriot Act. And I don't think anybody's looking, but it's something people should start looking at very carefully.
It's going to push more people into direct Bitcoin, so I love it. Okay, so we got about 7 more minutes, and let's talk about liquidity. And my quick story on liquidity. So I've been giving this same presentation, same panel, different speakers, for about a year now. And in Hong Kong, I asked the same question, liquidity. And what happens in the current financial world is you have a stock like Apple. And in a real financial world, exchange and broker are two different things. Well, in the Bitcoin world, your exchange is the broker. To give a more specific example for the non-traders, Apple stock sits on the NASDAQ exchange. But you can't trade on the NASDAQ exchange. You trade on Fidelity, you trade on E-Trade, if they still exist. Interactive brokers, which is what I use, that's why I know them. Options Express, whatever. And they all compete on fees, execution, trading tools. They don't compete on liquidity. They don't access the same pool of liquidity. In Bitcoin, that doesn't happen, and that's why you have these skews in prices where somebody just wants to buy a lot on one exchange or the other. So my question has always been, would Bitcoin benefit from a single pool of liquidity? But I also understand why it's so dangerous, because it's like a honeypot for a massive amount of Bitcoin, maybe up to 20, 30% of all Bitcoins out there. And on one of my panels, one of the panelists was Bobby Lee, and he just smiled and said, we're working on something. So that something turned out to be liquid. on side chains. So now we at least have a partial prototype of the sharing of exchanges, sharing of liquidity between exchanges. And I wanted to get the panel's view on that. And go ahead, Scott.
All right, so like picking up on what he was talking about, the concept of brokers and exchanges. A lot of the exchanges that are on the planet today are brokers, and they're brokering off of larger pools of liquidity. So one of the pieces of technology we have at Alpha Point to support our clients, it's called the remarketer. And what it does is it basically connects their exchange to larger pools of liquidity like Bitfinex. And it's fantastic because it enables a local region to have liquidity. So there is some concentration liquidity. It's definitely there. There's a handful of large pools, and a lot of the exchanges are acting as brokers in a lot of cases. Is it dangerous? I don't know if I'm the guy to talk about if it's dangerous or not, but I know that it does exist. There's probably just a handful of, there's Bitstamp, there's Bitfinex, there's BTC China, there's OKCoin, and that's probably your top 5 pools of liquidity on the planet right now.
And at least one of those, Bitfinex, supports Tether as today for moving liquidity. Alpha Point has a number of relationships as well with some of the exchanges he mentioned, and then of course there's the Liquid Network as well. So there's a variety of different businesses that are coming up right now to actually solve that problem, not to pool liquidity, but to make the access to those funds more instant across all the various organizations.
And there's also the issue of over-the-counter transactions. There's a significant amount of transactions that are off exchange, where someone takes their private asset, makes a deal with somebody else, and sells it, and vice versa.
Yeah, but those don't move the price. They don't really affect the general consumer.
Not as of yet, but if you create, and again, not that it sounds self-serving, you create a peer-to-peer network, you're able to move the assets. Once you move the assets to a certain amount, then that peer-to-peer network can then set its own price. And that can be done with everything. It starts with Bitcoin. Bitcoin is programmable. You can then inject the price feed in, and you do the same thing with Apple. Enough people trade Apple stock through this Bitcoin network, you set the price of Apple. Because more people start trading, or enough people trade peer-to-peer